Good morning from our global headquarters in New York. I'm Vonnie Quinn. Danny Berger is on assignment. Welcome to Bloomberg Brief. Let's set your agenda. Riding high, equities extending their rally after Fed Chair Jerome Powell downplayed growth concerns. President Donald Trump urging a rate cut. Next up, the BOE also expected to keep rates on hold. The United Kingdom posting strong wage growth ahead of that decision. And shares of Nvidia marching higher as Jensen Huang lays out plans to spend hundreds of billions of dollars on US-made chips and electronics. So let's take a look at those markets, because we did get a rip-roaring rally yesterday after the Fed decision. Now, let's not get carried away. We're talking about a 1.1% gain on the S&P 500, but it looks like we might be extending that gain into today's session. The Nasdaq 100 posted a gain of 1.3%. Now, we're still in correction territory, but if those gains continue today, we might just get out of it. The Nasdaq 100 futures there pointing to gains of more than 0.5% at the open. And even the Russell 2000 showing gains at the open today. Let's move on to bonds, because bonds were also higher. In fact, we saw a massive decrease in yields as traders started to price in perhaps more cuts by the end of the year, in contrast to what the median data is now saying. But look at that two-year yield. It's below 4%, 3.97 just a moment ago. That 10-year yield now down to 4.2274. And we're also keeping an eye on copper and gold, as well as sterling, of course, which is weakening ahead of the BOE decision and after the jobs data. Copper trading just off that 10,000 mark, which it did reach, and gold just off its record high, which it also reached as well. We're also keeping that eye on Nvidia. CEO Jensen Huang said in an interview with the Financial Times that the chip maker will be spending hundreds of billions of dollars in the US over the next 4 years. Shares of Five Below surging too after the discount retailer reported fourth quarter results that beat expectations, along with a solid sales outlook. And Carvana is rising after an upgrade from Piper Sandler to overweight from neutral, with a price target of $225. And in just moments, we're going to be speaking to Wei Li of BlackRock. Later in the hour, Torsten Slok of Apollo Management joins. So the S&P 500 posting the best Fed day then since last summer after Chair Powell downplayed growth concerns, even as the Fed came out with a revised economic projection for weaker growth, higher inflation. BlackRock weighing in on the rate path, writing, quote, "We think the Fed will find it difficult to cut more than once or twice this year, even if prolonged uncertainty starts to hurt otherwise healthy growth." Joining us now is Wei Li, Global Chief Investment Strategist at BlackRock. So, Wei Li, we did see a calm Fed chair yesterday, and obviously the equity market responded to that. But it was also a Fed chair that forecast weaker growth, higher unemployment, higher inflation. And that's not typically a good scenario for any economy. How do we get out of this conundrum?
I think heading into the FOMC, markets were rattled by recessionary fears. So the fact that, I guess, Fed Chair didn't play to recessionary fear helped sentiment. But I am a bit bothered by the fact that his characterization of the impact of tariffs on inflation as one-off. And he also characterized the labor market as balanced, but I still see tightness in labor markets that could keep wage pressure elevated. So bringing the two together, the way that he characterized the tariffs' impact on inflation and the way that he characterized labor market, I see that actually potentially leaving the Fed exposed to upside surprises to inflation. So far, as you say, Vonnie, that markets liked it, but I am a little bothered by the inflationary assessment. But the fact that we have come a long way in terms of positioning in U.S. equity market. You look at sentiment in U.S. equity market right now, bear sentiment is a recent year high. And the fact that recessionary pricing in our assessment is a bit overdone. So we like U.S. equity market, but I am a bit bothered by the inflation characterization.
Well, it does seem like traders, at least swaps traders, also feel like perhaps inflation might become, more of a difficult challenge later in the year. They're now pricing in 3 rate cuts, and Fed funds futures are looking at 2 plus a more than 50% possibility of a third. How many rate cuts do you see for the year? What would be, something that the Federal Reserve and the economy could live with?
We think that it's going to be quite hard for the Fed to cut more than twice. So market pricing of close to 3 cuts for this year is perhaps a bit overdone, because markets are still expecting the Fed to be able to come to the rescue of the economy if economy slows down. But the trade-off facing the Fed, i.e. the growth inflation trade-off, is becoming quite difficult. It's becoming very, very tough indeed. So faced with inflationary pressure, we don't think that the Fed can cut like they were able to in the past. And as a result of that, we think that actually the Treasury move to price in more rate cuts and yields falling is a bit overdone, which is why we are underweight U.S. Treasury. We are overweight U.S. equities.
Why then overweight U.S. equities if there are so many challenges out there? And you didn't mention the word transitory, but you spoke about how the Fed Chair characterized the potential inflationary impacts of all of the tariff policies that we might be seeing within the next few weeks. He also said that trade, fiscal policy, immigration and regulation will all need to be taken together, and the net effect of all of those judged. So clearly there is a lot of uncertainty out there. Why should equities keep rallying?
That's actually a great question. Let me clarify a little bit. We have an overweight in U.S. equities over the 6 to 12 month horizon, but in the very immediate term, and specifically I'm looking at April the 2nd, heading into a tariffs announcement, I think it's possible that markets could come under further pressure because of this significant policy uncertainty and the corresponding higher risk premium that investors ought to demand because of the higher policy uncertainty. But the big picture is that the U.S. economy is actually doing fine. Market pricing for increasing recession probability in our assessment, like at some point it was 10% peak to trough. Correction is overdone. We're talking about an environment where hard data is still holding up. Earnings expectation in our assessment should still also hold up, and any policy uncertainty can feed through to dragging economy down only if they prolong over an extended period of time. But we do think that pain in markets could force policy clarity. So over the 6 to 12 month horizon, we do believe that the case can still be made to be overweight U.S. equities, especially given the correction in multiples, and also the correction in very, very crowded positioning is behind us, actually.
Right, Whaley. So if we are looking not unattractive, are there spots in this market that look particularly cheap now or particularly attractive to jump in on? And what do you do with tech?
I would say that when we characterize our view on U.S. equities as overweight, we're staying tight with our overweight view rather than jumping in at this moment, because, as I said, as we head into further policy uncertainty, key dates, key events, and markets could be whipsawed and come under further pressure. But specifically to your question about tech has gone through significant actually derating. You look at NVIDIA, less than 25 times forward earnings. It is trading at a lower multiple than when ChatGPT was first rolled out. You look at Magnificent Seven, they're trading at similar multiple as when ChatGPT was first rolled out. And when we look at the fundamentals of the tech sector and of these companies, profitability, margin forecast for this year and next year, earnings, they haven't deteriorated significantly. You look at CapEx, which is a big thing that we are paying attention to understand how much pent-up pressure there is to further build out the AI infrastructure. Yes. They actually, the commitment, they have increased 40 times, the hyperscalers, 40% versus what was already a record year last year. So the fundamental picture in our assessment hasn't really deteriorated to warrant the significant repricing that we have seen in the sector, which is why we are also overweight tech at the moment. But obviously, near term, short-term uncertainty is something that investors ought to feel comfortable with to stick with the overweight.
Whaley, thank you so much. Whaley there of BlackRock joining us. And coming up, rearming Europe, that's on the agenda as EU leaders' defence summit takes place. We'll go to Brussels next. This is Bloomberg. This is Bloomberg Brief. I'm Bonnie Quinn in New York. Ukrainian President Volodymyr Zelenskiy has agreed to a proposal for a mutual halt to strikes on energy assets. That as an initial step in President Trump's effort to end the war in the region. For the latest, Bloomberg's Oliver Crook joins us now from Brussels. So, Ollie, Ukraine has agreed to the partial ceasefire, at least on those energy assets. What's the read on this out of Europe?
Yeah, so listen, I think everybody is taking, at least very publicly, a very positive approach towards what Trump is doing and the sort of way that he's going about this, because I think he's made it very clear that there is his way or the highway in terms of how these negotiations go. We saw that after the blow up with the Oval Office with Zelenskiy a couple of weeks ago, then the withdrawal of the military aid and intelligence from the United States. And the Europeans have been often very sort of impotent throughout this process in terms of being able to actually get Trump, steer him in either direction. So basically, everybody has been trying to sort of get on board with the Trump plan here. We understand also when we heard from Steve Witkoff yesterday, who's been the sort of chief negotiator so far in terms of the ceasefire proposal with Putin and really sort of laid the groundwork before that call between Trump and Putin, that he also did brief some of the European leaders. We understand he spoke to Emmanuel Macron yesterday, who responded very positively. So I think overall there is a sort of sense that the Europeans are getting on board with what Trump is sort of planning. There is, however, a sort of moment of reserve here. There is a lot of mistrust that Putin is really sort of sincere about his efforts on a sort of ceasefire deal. And there is also not a sort of clear understanding that Trump and Putin are really as on the same page as the administration would like to present. That being said, there is forward progress being made, and that is being sort of welcomed here in Brussels.
And then, of course, the EU leaders are arriving just now in Brussels, really ahead of their meeting to discuss defence spending. What are we expecting to learn out of that meeting?
So what we're expecting to get is basically the concrete proposals of the sort of outline that was laid out by Ursula von der Leyen a couple of weeks ago, which basically is this Rearm Europe Plan 2030. And this is basically getting the European economy and the various member states onto basically fighting footing potentially in the next 5 years. There's been massive underinvestment on the European side into the defense sector. So there are a number of initiatives that have been proposed by the European Commission, which will now be reviewed by the member states, the leaders of the member states. That includes a large sort of set of loans, 150 billion euros from the EU to nations, to member states in order to build out military, maybe changing the mandate of the European Investment Bank so that they can invest more directly into defense, rerouting different funds. So this is something that was outlined a couple of weeks ago. This is the point at which it becomes sort of concrete policy, concrete language, and then moves forward into the sort of initiative of actually getting into policy. What is interesting, and I'll just end with this, is that we heard something from the French, which I thought was very, very interesting, which is basically indicating that more and more of this money needs to be spent within Europe on European hardware, because if the U.S. administration is proving itself to be an unreliable ally, if you are fully dependent on that American hardware, they could use that against the Europeans in the future. And of course, a lot of these instruments, a lot of these sort of military hardware need software updates and need the United States in order to run. And that is something that is also weighing on leaders, though very few will acknowledge it openly.
Protectionist comments there as well. Oliver, thank you so much. That is Oliver Crook for us in Brussels. Well, over in Washington, President Donald Trump said the Fed should cut rates to help his incoming regime of reciprocal and sectoral tariffs, quote, ease their way into the economy. The post on Truth Social splits with previous comments from his administration that their focus was not on rates, but on the U.S. 10-year Treasury yield. Bloomberg's Kevin Whitelaw joins us now from Brussels. Kevin, are we seeing Trump return to pressuring the Fed chair? Will it have any impact?
I mean, this is something that I think everyone knew was going to happen and keep happening, you know, despite various protestations. Trump has always had opinions about the interest rate and where it should be. He's usually disagreed with whoever the Fed chair is, whether or not he's been president. So during Trump's first term, we heard these kinds of calls a lot. And of course, we're hearing it again now. Trump's basic philosophy seems to be that, hey, I'm going to do these policy things and the Fed should be helping me out. That's obviously not the way the Fed normally looks at it. They sort of process, the economic data and then make their decisions based on that. And so I think that's probably going to continue. But obviously in the background is that question about, what Trump might or might not do down the line when it comes to Jerome Powell's job.
For sure. Well, tariffs, as we know, are definitely still coming April 2nd. And now India is going to be included, according to the president. What do we know about what kind of tariffs will impose on Indian goods?
Well, at this point, we're really expecting this to be a global thing. And essentially what they're saying is there really are no exclusions. But we do expect potentially different rates for different countries. And so I think everybody is trying to understand what they really mean, how serious they are. Is this the beginning of a negotiation, or is this simply the beginning of a structural change that Donald Trump is trying to make with the world economy, one that could be incredibly disruptive and incredibly painful, both to U.S. trading partners, but also potentially to the U.S. economy. And so one of the things from the European side they'll be looking at is whether or not they try to apply different tariff rates to different countries within the EU, which has yet another potential to sort of make it even more challenging for the European Union to figure out how to react to what potentially an uneven set of tariffs.
All right, Kevin, we have to leave it there. Thank you so much for all that perspective. That is Kevin Whitelaw for us in Brussels. Coming up, we'll push ahead to the Bank of England decision in just a few hours. That's next. This is Bloomberg. This is Bloomberg Brief. I'm Vonnie Quinn in New York. Time now for our front page news, a look at what's making headlines around the world. First up, the Financial Times reporting Nvidia will spend hundreds of billions of dollars on chips and other electronics manufactured in the US over the next 4 years. The company is tilting its supply chain back from Asia in the face of the president's tariff threats. In a wide-ranging interview with the FT, Jensen Huang said he also sees a growing competitive threat from Huawei in China. Next up, the Wall Street Journal reporting the Trump administration is considering a plan to extend Chevron's license to pump oil in Venezuela. The president's team is weighing a plan to impose tariffs or other financial penalties on countries that buy oil from Venezuela. Chevron has long warned that China could tap into Venezuela's oil resources if the company's license is revoked. And on the Bloomberg, UK wage growth held at its highest level in 9 months and employment rose. This all evidence of a tight labour market and will likely keep the Bank of England cautious over further rate cuts when it meets today. Our UK correspondent Lizzie Burden joins us now from outside the Bank of England in London. So Lizzie, break down the jobs data and what position it leaves the BOE in.
Well, Vonnie, this data came in bang in line with expectations, but you put it right. The bottom line is it really underscores that tightness in the labour market continuing, which is not going to do anything to assuage the BOE's concerns about the persistence of inflation here in the UK and the second round effects, because caution really has been the watchword out of all of the Bank of England commentary that we've had since the last decision. You've heard it from the likes of Dave Ramsden, the Deputy Governor, who's kind of seen as a bellwether on the Monetary Policy Committee. You've seen it from even Catherine Mann, who, you'll remember, surprised the markets last time by going from arch hawk to arch dove by voting for that jumbo cut. And then now she's been emphasising the need for policy to remain restrictive. So we're expecting a hold today. We're expecting them to keep this guidance that the path ahead will be careful and gradual, but we don't get a presser, we don't get forecast. The expectation in markets, though, you'll get 2 more cuts after this.
Well, and of course, sequencing matters, and this BOE decision comes before the Chancellor's spring statement next week. How will it impact that statement?
Well, of course, Rachel Reeves would love it if the Bank of England would make her life easier, Vonnie, and just make government borrowing cheaper. But it looks like her headroom that she left herself at the October budget has been eroded. And interestingly, I was speaking to the Chancellor on Monday, and she heavily hinted that it's important to her to rebuild that fiscal cushion at the spring statement next week. It was only £9.9 billion. And indeed, our reporters Phil Aldrich and Joe Mays have had it confirmed that she's going to rebuild at least £9.9 billion of headroom. Now, she's ruled out more tax rises. She's ruled out bending her fiscal rules, so that leaves spending cuts. And given that we already know some of that's going to come from welfare cuts, this is something that she's getting absolutely slated for from the left wing of her party. And, Vonnie, the thing that really is fascinating to me is it seems she cares less about that left wing than she does about the bond vigilantes swirling the UK government.
For sure, and of course we're also seeing sterling weaken, and that's obviously a today move, but we have seen the governor begin to speak a little bit about tariffs, Lizzie, which is interesting because they had been avoiding talking about the potential impact of any US tariffs until fairly recently. Should we anticipate hearing anything about potential tariff impacts today, given that we already did from the ECB?
Well, no press conference today, Vonnie, but in the last meeting's guidance, they did add that word careful in response to the uncertainty around Donald Trump's tariff threats. Now, the UK looks for now like it's going to avoid Donald Trump's tariffs, but there is, as you suggest, the ripple effects from tariffs on the EU and China that would keep the UK in the crosshairs here. And this is partly what is fueling the concerns about the second round effects. If you have businesses and consumers, inflation expectations raised as a result of those tariff threats, and then you have wages higher and prices higher, that could cause a problem for Threadneedle Street.
For sure, Lizzie, thank you so much. And Lizzie will be outside the Bank of England all morning long. Don't forget, that decision comes at 8 a.m. Eastern this time round. There's only 4 hours between us and London during daylight savings time. Coming up, the Fed flagging stagflation risks, lower growth and higher inflation. Apollo's Torsten Slok next. This is Bloomberg. From our global headquarters in New York, welcome to Bloomberg Brief. I'm Vonnie Quinn. Let's set your agenda. Riding high, equities extending their rally after Fed Chair Powell downplayed growth concerns. President Donald Trump urging a rate cut. Next up, the Bank of England also expected to keep rates on hold. The UK posting strong wage growth ahead of that decision. And shares of Nvidia marching higher as Jensen Huang lays out plans to spend hundreds of billions of dollars on US-made chips and electronics. Let's have a look at those markets, though, because we are just fading a little bit, but we are still higher. That would be after the best day since last July for equities after a Fed meeting. We see S&P futures up about 0.2% now. The S&P 500 did rise about 1.1% in yesterday's session after the Fed chair's comments. The Nasdaq 100 still in correction territory, still down about 11% for the year, but those futures look to be rising as well after a 1.1% gain yesterday. And even Russell 2000 futures are higher, although, as I said, with just about 4 hours to go, we are fading those gains. Let's look at the bond market because we had some very interesting moves. 10 basis points drops in many cases. The 10-year yield down to 4.22. The 2-year yield is now below 3.97. So that bond market is definitely pricing in more rate cuts to come. The 30-year yield at 4.52 right now. And then let's just take a quick look at copper and some other precious metals. Gold just off its record high, which it hit after the Fed decision, 357 it was at. It's now at 3,045. Copper just coming off the $10,000 mark. There's apparently between 100 and 150,000 tons of copper redirected from Asia on its way into the United States, just in case those tariffs do go on copper later in the month and in the year. And sterling weakening even further now, 129.49 before the BOE decision. So the Fed then out with a fresh summary of economic projections for the year. GDP revised down, PCE inflation revised up. Apollo's Torsten Slok writes this. The FOMC message is that we are in a stagflation economy with lower growth and higher inflation. I'm pleased to say Torsten joins us now. He's chief economist at Apollo. Torsten, that is the dreaded scenario, and you say we're already in it. Did the Fed just prove that yesterday?
Well, I think the challenge for them is the following, that there are two things in the economic outlook that are very, very important. First of all, sentiment has already deteriorated for consumers. We've seen consumer confidence go down significantly. We've seen the expectations to business conditions go down significantly. And we've seen the expectations to inflation also go up significantly. That's, in other words, consumers are saying we are getting some stagflation, and that will likely continue. Corporates are also saying that confidence is now weaker. They are saying that CapEx plans to expand their businesses, has also been going down. So this sentiment deterioration has been very significant. But what markets are not pricing in particular equity markets yet, is that these effects will likely have some negative consequences for earnings. Tariffs and trade wars do have negative impacts on earnings, and that's what still remains to be seen, namely how negative will that impact be. So that's why the optimism in equity markets here at the moment is unwarranted, when you both have sentiment that is quite negative and at the same time the coming negative effects of tariffs on earnings in the US.
Sure. The Fed chair, though, downplaying those survey-based inflation expectations and also some of the consumer data, he didn't seem to be too concerned about what they were showing. He thinks inflation expectations are still well anchored, particularly market-based ones.
You're right, Vonnie, and that was actually very unusual. If you look at inflation expectations, in particular University of Michigan, both 1 year and 5 to 10 year was really going up in the last print. And in that sense, it was somewhat surprising that he's downplaying that and saying, oh, we're not too worried about that. There are some issues around who are the respondents in the University of Michigan survey in inflation expectations. And it is correct to say that market-based inflation expectations have been well behaved, at least more well behaved. But the bottom line to your question is that it is a little bit surprising that he just decides to say, oh, the sentiment data may be bad, and we're only looking at the hard data, because it's always the case that sentiment leads the hard data that potentially could be slowing down. And the next important data point will be non-farm payrolls on April the 4th. The survey week for that was last week, because the survey is always done in the week with the 12th. And of course, if you look back to last week, the fears and some of the heightened uncertainty is bringing the conclusion that there is a risk that non-farm payrolls could be weak in March when it comes out on April the 4th.
Well, certainly the Fed is looking for the unemployment rate to go up at some point this year, right? Just by a tick, but nevertheless. So if that is the case, that we have gone from navigating a soft landing to actually trying to navigate stagflation, if that's even possible, is there a way for the Fed to finagle rates or monetary policy to get us out of that stagflationary environment quickly?
Well, that's a very, very important point, because the difficult thing for the Fed is that when growth slows down, which is the stack part of stagflation, then the Fed should be cutting. Well, the inflation side of the problem is that if inflation goes up, which was their forecast, then the Fed should be hiking. And they are revealing their hand in the sense that they are putting in the dot plot that they do expect that rates will be going down. And he did also say yesterday that if we did have a deterioration in the growth outlook, we would be putting weight on that. But it really is bringing some very fundamental discussions at the moment, namely, Paul Volcker clearly did say inflation was going up. That's what we're fighting. But here, Powell is almost leaning a bit in the other direction of saying, yeah, we know that inflation is high, but if growth slows down, we will be looking at that as a key driver of our decisions. So that's why it is a very, very difficult spot for the Fed to decide, should they be hiking rates, should they be cutting rates when there's stagflation. I do think that they have told us that they will be cutting, but that comes with some risks, of course, to inflation, including also inflation expectations.
Why is the Fed chair, and indeed perhaps more members of the Fed, so convinced that any bout of inflation that we might see that would be directly or, semi-directly, thanks to the tariffs that might be put in place, that would be transitory inflation? Yeah,
Vonnie, that was a very important part of yesterday and very interesting. I mean, the fact that we are having a transitory discussion again, because the issue, of course, is that when we all talk about if the price of my avocado or my car goes up because of tariffs, it may be that this is only once, but that's assuming that there only is one set of tariffs. What if there's more tariffs coming? What if these tariffs are implemented gradually? What if these tariffs begin to have implications for inflation expectations? What if these tariffs begin to have implications for wage expectations? There are so many other domino bricks economically that you can begin to think about. How are they falling if there is just one shock from tariffs? So it's correct to say that the price of things would potentially only go up once, but all the side effects of raising the price of things are such that that it could have a number of other, in many cases, unintended consequences for the inflation outlook, and therefore be something that could have a more persistent upward pressure on inflation.
Torsten, very briefly, why is the market pricing in 2 to 3, potentially even now swaps market pricing fully in 3 cuts this year?
Yeah, this is really interesting. Also, if I look at equities, they are down like at 10% of the correction. I mean, that's like saying, wow, the Fed is going to cut 10, 15 times. But rates markets are saying, no, hold on, inflation is still too high. So that's why the Fed is only going to cut 3, 4 times. And I think that backdrop, that difference between the sentiment being quite negative in equity markets about corporate earnings is quite different from the sentiment in rate markets, which is tending to put more weight on inflation. And that's back to the stagflation risk. Namely, the stag part of the outlook is that equities are worried about earnings, and the inflation part is that the Fed is worried about inflation being higher.
Torsten, thank you so much for all of that perspective. That is Torsten Slok of Apollo Management, and it is much appreciated. We've got a little breaking news now. Mark Carney expected to call snap elections for April 28th. This is according to the Canadian Globe and Mail. Once again, Mark Carney, who just took over from Justin Trudeau as leader of the Liberal Party, expected now to call snap elections for April 28th. And we do have the Canadian dollar weakening versus the US dollar right now. This is Bloomberg. This is Bloomberg Brief. I'm Bonnie Quinn in New York. Ukrainian President Volodymyr Zelenskiy agreeing to a proposal for a mutual halt to strikes on energy assets as an initial step in President Trump's effort to end the war started by Russia. For the latest, Bloomberg's Greg Sullivan joins us now from Dubai. So, Greg, Ukraine has agreed to this partial ceasefire on energy assets at least. What is the sense outside of the United States? Is it that this is a positive move towards a broader ceasefire, or are there other elements in the reaction?
Well, in some sense, Ukrainian President Volodymyr Zelensky just didn't have many choices. He's in a very tough spot right now. We've seen the White House heaping pressure on the Ukrainian side and acting in a much more conciliatory way towards Russia in terms of how the negotiations are proceeding and the concessions that they are demanding. If you remember, after that last White House meeting, the U.S. actually suspended military aid and intelligence sharing, which put Ukraine in a very difficult place because it relies on both of those. So in some ways, Zelensky had to come to the table and had to agree to something. The onus had originally been on Russia to agree to that 30-day truce, which they clearly did not. But agreeing to halts on military or strikes on energy facilities was something that both sides could agree to, and Zelensky basically had to show up and accept. Where it goes from here, though, is still a big question.
Yeah, and of course, EU leaders themselves arriving in Brussels ahead of their meeting today to discuss defence spending. What are we expecting to learn from that meeting?
Well, there's a few things at play here. One is that the meeting is really about translating these bigger and broader plans for taking hold of their own security architecture, defense spending, building out the defense industry into more concrete steps, to actual plans of action from just broad contours. But there's also concern among European capitals that they are being left out of the negotiations that Trump is pursuing for a ceasefire directly with Russia. So European leaders will also be seeking ways to maintain that relevance, to maintain that seat at the table, and make sure that their own security architecture is not decided without their input. And even more broadly, we'll see trade come up as Trump administration continues to roil trade markets with tariffs and talks of trade war. Europe really has to consider how to become more competitive. So all of that will be on the table at the summit, leading with Ukraine, of course.
All right, Greg Sullivan, thank you so much for joining us. That is Greg Sullivan there out of Dubai. Now to Washington, President Trump diverting from his administration's previous comments on the Federal Reserve. He's saying now that the central bank should cut rates to help his incoming regime of reciprocal and sectoral tariffs ease their way into the economy. Previously, his team has said that their focus wasn't on rates themselves, but just on the 10-year Treasury yield. So let's bring in Bloomberg's Kevin Whitelaw now, who joins us from Brussels to discuss this. Kevin, are we seeing the president return to pressuring the Fed chair? He had eased off a little bit, it seemed. Or are we expecting Powell to just shrug off these posts on Truth Social continually?
Yeah, I mean, what we expect the pattern to be is that Trump is going to make noise and Powell is generally going to ignore it. But obviously, the Powell is going to have some decisions to make down the line about, whether he thinks his job security is on the line and whether or not that matters, should factor into his own thinking. But for the most part, Trump has always had opinions about about interest rates. He's rarely, shied away from expressing them. So we know that Trump believes that those interest rates and the interest rate policy should be serving his policy goals, whereas obviously from the Fed side, it should be about serving the broader economic health of the United States.
Well, his mind is obviously on tariffs, and he has said they are still coming. April 2nd will be the implementation day. India is going to be included in them now as well, according to Donald Trump. What is the latest on these tariffs? Have you any more insight into what we'll see?
We are waiting really to see what these are going to look like. The numbers aren't clear yet. The range isn't clear yet. Trump has said a number of different things when it comes to what these tariffs are going to look like. They're going to be huge. They're going to be gradual. They're going to be global. They're going to be, and then some of his advisors have suggested that there may be some room for negotiation. So we are expecting variations across different countries and potentially across different sectors. And that's going to be a potential challenge for blocs like the European Union, who really try to tackle trade policy as a whole bloc. But if there's 27 different rates, that gets complicated. Trump has said that they're going to take into account so-called non-tariff barriers. This is things like the value-added tax in his mind, which really isn't a trade tool, but is just a straight tax. Having said that, depending on how this is all factored in, on top of those tariff rates, you're going to have this threat of reciprocal tariffs, which means that any kind of retaliation from other countries will then have a retaliatory automatic effect in the U.S., apparently. So all of this leads to a very uncertain situation, and everyone's waiting to see what the legal language is when it comes to these tariff proposals.
And Greg, just on U.S. economic data, we're going to get initial jobless claims a little later this morning, but obviously there's going to be a focus on federal jobless claims data, and that comes out after the market closes. Judges have been trying to force DOJ to turn over its records. What's the latest on the struggle by the states against Elon Musk's initiative?
Well, this really is an important court fight. There's a lot of court fights already underway, and there's going to be more. But this really is about access to information and access to just understanding what exactly the Elon Musk and his DOJ team are up to when it comes to their activities in the federal government. We have seen them make various kinds of recommendations and decisions almost about cutting programs, about suspending programs, but there's been no transparency really about what that actually has meant, what the process is, who's making the decisions, is it getting sign-off from folks more broadly in the administration, and that's the kind of access that these states are looking for. And so the real question is, who ultimately, if anyone, has the ability to challenge the kinds of decisions that are being made and make sure that they're actually following various legal protocols? And just as importantly, is the Trump administration going to act and feel bound by court decisions? We've already seen Musk, we've already seen President Trump challenge really the ability of these judges to try to step in. This really is a fight that I think we're going to keep seeing over and over and over, and likely will often end up in the Supreme Court.
All right, Kevin, thank you so much. That is Kevin Whitelaw for us out of Brussels. Now to a stock we're keeping our eye on. NVIDIA extending gains in the pre-market now, outpacing those of the NASDAQ 100 futures. And that's after snapping this week's decline already. This move is following news from the Financial Times that NVIDIA is planning a massive outlay on US-made electronics. For more, let's bring in Bloomberg tech editor Mark Bergen. Mark, Huang's comments to the FT come in the wake of other big US tech companies drumming up their domestic investments. Is this a bit of pageantry, do you think, for President Trump's America First policy? Or will investors actually see this outlay as a significant move and a positive move from the chipmaker?
Yeah, I think they'll see it as a significant move of pageantry. I mean, this is largely a political move, right? This is ingratiating itself with the administration. It is doing like onshoring. It's something they're continuing to work with their main manufacturing partner, TSMC. They just say down they're moving those resources to U.S. production rather than Taiwan. And we haven't. There was no signal that NVIDIA was not going to come out and say what they've said in this past week, right? That we're launching a new chip, that they're seeing a lot more growth. They have this expectation about this continued spending on AI investment, which is, we've seen from their largest customers in Silicon Valley have said that they're going to continue to expand their capex. So I think this is a sign that maybe the Trump administration might go easy on NVIDIA. There is an open investigation from last year from the Department of Justice around antitrust.
Yeah, for sure. And then the other thing that was happening, it felt like all day long yesterday, was that Jensen Huang was trying to cool fears caused by DeepSeek surrounding the money going into AI capex. What exactly was his argument? Was it compelling to investors?
Yeah, to investors, sure, if you see the bump. I believe the stock certainly has recovered some from that major dip, like a record dip we saw in late January. The argument here is something that's consistent with what Microsoft and Google and Amazon have said. Okay, if DeepSeek has shown that they can produce a cheaper model than, say, the OpenAIs of the world, there actually will be an increase in AI spending, and there's still this kind of untapped demand. I think the argument that Huang made in part was we're misinterpreting the model. There's been some arguments that maybe what DeepSeek did was kind of based off piggybacking on the work of others like OpenAI that have used much more computing intensive and much more NVIDIA chips. And so the logic there is that we're not going to see AI developers cut back on spending on chips. And to be clear, when they're spending on chips, they're spending on NVIDIA.
Yeah, exactly. Mark, thank you so much. And that is Mark Bergen for us. But don't miss our special Bloomberg Technology show out of San Jose and the NVIDIA GTC AI conference. That takes place at 4:30 p.m. Eastern, and you don't want to miss it. Now to other top stories trending on the terminal this morning. EQT will return $5.4 billion to investors this week after completing the sale of a stake in Nord Anglia Education. The investment was initially made in 2008 and was reinvested again in 2017 through a different fund. Sources say it has since delivered nearly 4 times its invested capital. A spokesperson in London declined to comment on the fund returns. Sources say cloud computing provider CoreWeave is seeking to raise about $2.5 billion in an IPO. The NVIDIA-backed company and current shareholders are planning to offer the shares for $47 to $55 apiece. It's expected to disclose proposed terms for the listing and begin marketing the shares today. A representative for CoreWeave declined to comment. New York City subway riders will no longer need that physical Metro card by the end of this year. Riders will instead be encouraged to adopt the already popular contactless tap-and-go payment system. The final day for Metro card sales and distribution will be December 31st, and the MTA estimates it will save at least $20 million annually in production and distribution costs. Coming up, more rate decisions and economic data in your day ahead. Context matters on Bloomberg. What's ahead today? The BOE's rate decision coming in at 8 a.m. Eastern Time, just more than 2 hours from now, and that's followed by Governor Bailey's news conference. Then U.S. initial jobless claims coming at 8:30 a.m. Eastern. They'll be watched very closely after the Fed decision yesterday. Existing home sales at 10 a.m. Plus, we'll get earnings after the market close from Nike, FedEx, and Micron. Some analyst calls this morning. KKR raised to overweight at Wells Fargo. Price target there, $141. FCX, Freeport McMoran, raised to overweight at JP Morgan. The price target there, $52. And you might want to keep an eye on Southwest as well. Raised to neutral at UBS. The price target there, $36, as you can see. Very close already to that price target. Let's take a quick look, though, at the 10-year yield. Arguably, the 2-year yield is the one that's more in tune with what the Fed is saying, but the 10-year yield shows it very, very clearly. That big drop in the last day and a half since we got that Fed decision and those comments from Fed Chair Jerome Powell about any potential tariff inflation bump being transitory. Well, you have the market pricing in more cuts, and that 10-year yield now down 10 basis points since those comments to 422.16. That's it for Bloomberg Brief. Surveillance is ahead. Context matters on Bloomberg.